So let me paint you a picture. You just got your tax refund. Maybe it's a bonus from work. Maybe you finally sold that old car you've been trying to get rid of for months. Whatever it is, you've got $1,000 sitting in your checking account right now, and you're staring at it like it's some kind of puzzle you're supposed to solve. You open up Reddit, you check TikTok, someone's screaming about crypto, your coworker won't shut up about some stock that tripled, your mom's telling you to just put it in a CD, and you're sitting there completely paralyzed doing absolutely nothing with it while it loses value to inflation every single day. Yeah, that's what we're fixing today. My name's Santosh, and I spend way too much time thinking about how regular people can actually build wealth without turning into full-time day traders or finance bros. If you're someone who's tired of watching your money sit in a checking account earning basically nothing, but you're also terrified of making the wrong move and losing it all, hit subscribe and give this video a thumbs up, because what I'm about to show you is probably going to challenge everything you think you know about investing small amounts of money. Here's the thing. When you have $1,000, everyone treats it like it's either too much to risk or too little to matter. And that psychological trap right there, that's what keeps most people broke. I'm not even exaggerating. There's data from the Federal Reserve showing that nearly 60% of Americans couldn't cover a $400 emergency without borrowing money or selling something. 60%. But here's what most people don't realize. That same $1,000, if you actually deployed it correctly right now in 2026, could be the foundation of genuine financial security. Not get-rich-quick nonsense, real compounding, life-changing money. But first, we need to talk about what you're not going to do with this money. You're not putting all of it into whatever coin some teenager on Twitter says is going to the moon. You're not buying individual stocks based on a hunch, and you're definitely not leaving it in your checking account where it's actively losing purchasing power every single day. Now look, I know that sounds boring. I know you probably clicked on this video hoping I'd give you some secret investment that's going to turn your $1,000 into $10,000 by next month. But if that's what you're looking for, this isn't the video for you. What I'm going to show you instead is something way more powerful, a systematic approach that removes emotion, maximizes probability, and actually works. Before we put a single dollar into the market, we need to talk about something that nobody wants to hear, but everyone needs to understand. Emergency funds. Now, you might be thinking, Santosh, I clicked on an investing video, not a savings lecture. I get it, but here's where it gets interesting. The reason most people fail at investing isn't because they picked the wrong stocks. It's because they invested money they actually needed, panicked when the market dropped, and sold at the worst possible time. I've seen this play out hundreds of times. Someone throws their entire savings into the market, their car breaks down 2 months later, they're forced to sell at a loss to cover the repair, and now they're convinced investing doesn't work. So here's what we're actually doing with that first $1,000. If you have zero emergency savings right now, we're taking 300 of that 1,000 and we're putting it somewhere boring and accessible, a high-yield savings account. As of 2026, you can still find accounts paying around 4 to 4.5%. Is that going to make you rich? No, but it's going to stop you from sabotaging your actual investments when life happens, and life always happens. That leaves us with $700 to actually invest. Now, this is where most finance content completely falls apart because they either tell you to dump it all into index funds without explaining why, or they overcomplicate it with 15 different asset classes and rebalancing schedules that require a spreadsheet and a finance degree. We're doing neither. Here's what I would do with $700 in 2026, and more importantly, here's why each piece of this matters. We're splitting this into 3 buckets: the foundation, the accelerator, and the wild card. Stay with me. This is going straight into a broad market index fund, specifically something tracking the S&P 500 or a total market index. Now look, I know this sounds basic. It is basic, but basic isn't the same as ineffective. Here's what most people don't realize about index funds. When you buy into something like VOO or VTI, you're not just buying stocks, you're buying a mathematical certainty based on human progress. Think about it. The S&P 500 is literally the 500 largest, most successful companies in America. These are businesses with armies of lawyers, accountants, engineers, marketers, all working every single day to generate profit. You're not betting on one company. You're betting on American capitalism continuing to function. And historically, that's been a pretty safe bet. Over the last 50 years, the S&P 500 has averaged about 10% annual returns. Some years way more, some years way less, some years negative. But zoom out and the trend is undeniable. If you had invested $400 in an S&P 500 index fund in 1976, adjusted for inflation, accounting for dividends, you'd have over $30,000 today. That's not speculation, that's data. But here's where the psychological trap gets people. $400 feels like nothing. You're thinking, Santosh, what's 10% of 400? That's 40 bucks a year. Who cares? And you're right, that first year return is small, but this is where the math gets beautiful. That 400, if left alone for 30 years at 10% average annual return, becomes $7,000. You didn't do anything. You didn't watch the market. You didn't time anything. You just left it there. And if you kept adding just 50 bucks a month to that 7,000, that becomes over 100,000 from basically nothing. This is where we get slightly more aggressive but still smart. This portion is going straight into a growth-focused ETF or a sector that I believe has structural tailwinds over the next decade. As of 2026, I'm looking hard at technology innovation, specifically things tied to artificial intelligence infrastructure, clean energy transition, or emerging market growth. Something like VGT for technology, ICLN for clean energy, or VWO for emerging markets. Here's the thing about sector investing. It's riskier than broad market index funds because you're making a bet on a specific theme. But if you're young, if you have time, if this isn't your life savings, this is where you can potentially outperform. The S&P 500 is amazing, but it's weighted towards whatever is big right now. Sector funds let you overweight what you think will be big tomorrow. Now you might be thinking, isn't this just stock picking with extra steps? Kind of, but there's a massive difference. You're not betting on whether Tesla or Nvidia or whatever individual company wins. You're betting on whether the entire sector grows. And sectors are way more predictable than individual stocks. We know the world is going to need more energy. We know AI isn't going away. We know developing countries are going to keep growing. The question isn't if, it's how much and how fast. Here's the math on this. Let's say this sector fund averages 12% annually instead of 10%. That extra 2% might not sound like much, but over 30 years, that $250 becomes over $6,000 instead of $4,000. That's a 50% difference from a 2% variance in returns. This is why getting slightly more aggressive with a portion of your portfolio actually matters. This is the part everyone wants to hear about, so let's talk about it honestly. This $50 is your play money, your learning fund, your I want to feel like I'm doing something interesting fund. And here's where I'm going to say something controversial. I think everyone should have a small amount of money in something speculative. Not because it's going to make you rich, because it's going to scratch the itch that makes you do something stupid with the other $650. Human psychology is weird. If you tell someone they can't have something, they want it more. If you build an entire portfolio of boring index funds and tell yourself you're not allowed to take any risks, eventually you're going to break and you're going to do something dumb with a lot more money. So instead, we're giving ourselves permission to speculate with $50. Maybe that's a small position in Bitcoin. Maybe it's an individual stock you believe in. Maybe it's a micro-cap growth fund. I don't care. Just keep it to $50. Here's the beautiful part. If this goes to zero, you're out 50 bucks. That's a nice dinner. It's not life-changing. But if it somehow does really well, if you pick something that genuinely runs, now you've got a story, and you didn't blow up your actual financial future to get it. This is psychological portfolio management. We're not just optimizing for returns. We're optimizing for you actually sticking with the plan. Okay, so we've got our allocation. 300 in emergency savings, 400 in S&P 500 index fund, 250 in a growth sector, 50 in whatever speculative thing keeps you sane. Now comes the part where most people completely sabotage themselves, the execution. Here's what you're going to want to do. You're going to want to check your account every day. You're going to want to read headlines. You're going to want to sell when things drop and buy when things feel good. Don't. The single biggest destroyer of investment returns isn't market crashes, it's investor behavior. There's a study from Dalbar that gets updated every year, and it consistently shows that the average investor underperforms the market by 3 to 4% annually. Not because they picked bad investments, because they bought high, sold low, and constantly reacted to noise.
So here's your actual execution plan. You open a brokerage account, Fidelity, Vanguard, Schwab, doesn't matter. They're all basically the same. You buy your funds and then, this is the hard part, you do nothing. You don't check it for at least 6 months, ideally a year. You set up automatic contributions if you can, even if it's just $25 a month, and you forget about it.
Now, you might be thinking, Santosh, what if the market crashes right after I invest? Great question. Here's what most people don't realize. Your timeline is decades, not days. If you're watching this video, you're probably under 40. That means you have at least 20 to 30 years before you need this money for retirement. In that time frame, there will be multiple market crashes, multiple recessions, multiple moments where financial media is screaming that everything is falling apart. And every single time, if you just held, if you just kept contributing, you made money. Let me give you a concrete example. If you invested $10,000 in January of 2000, right before the dot-com crash, and you just held it through the crash, through the 2008 financial crisis, through COVID, through everything, you'd have over $40,000 today. But if you tried to time it, if you sold during the crashes and bought back when things felt safe, you'd probably have less than 15. The math on this is brutal, and it's consistent. Time in the market beats timing the market, every time. Real quick, we need to talk about account type, because this actually matters more than people think. If you're investing this $700, you have 3 main options: a taxable brokerage account, a Roth IRA, or a traditional IRA. Here's the breakdown. Taxable brokerage account. You can access this money anytime, no penalties, but you pay taxes on gains. If you think you might need this money before retirement, this is your move. Roth IRA. You contribute after-tax money, but it grows completely tax-free, and you can withdraw it tax-free in retirement. There are income limits and contribution limits, $6,500 for 2026 if you're under 50, but if you qualify, this is probably your best option. Here's why. That $400 in an S&P 500 fund growing to $7,000 over 30 years, in a taxable account, you're paying capital gains tax when you sell, maybe 15, maybe 20% depending on your bracket. In a Roth, you keep all of it. That's over $1,000 in taxes you just avoided. Traditional IRA. You get a tax deduction now, pay taxes later in retirement. This makes sense if you think you'll be in a lower tax bracket when you retire. For most people under 35, Roth makes more sense. My move? If you can, open a Roth IRA and put the $700 there. You're locking in tax-free growth forever, and you're forcing yourself to think long-term. Here's where we need to zoom out and talk about what this is really about. This isn't just about turning $1,000 into more money. It's about rewiring how you think about wealth. Most people treat investing like gambling. They're looking for the big score, the quick win, the thing that changes everything overnight. And that mindset is exactly why they stay broke. Wealth isn't built through one big move. It's built through hundreds of small, boring, consistent decisions. It's putting money in when you don't feel like it. It's not selling when you're scared. It's adding $25 a month even when it feels pointless. Here's what nobody tells you. The difference between people who build wealth and people who don't isn't income. Plenty of high earners are broke. It's not intelligence. Plenty of smart people are terrible with money. It's consistency and patience. That's it. That $1,000 you're investing today, it's not going to change your life tomorrow, but it's proof that you can delay gratification. It's proof that you can think long-term. And that shift, that mental shift from I need results now to I'm building something that compounds, that's what actually separates people who build wealth from people who don't. Look, I know this isn't sexy. I know you probably wanted me to tell you about some secret stock or some crypto that's going to explode. But here's the truth. Financial freedom isn't complicated. It's just unsexy. It's index funds. It's patience. It's not panicking. It's doing the boring thing consistently while everyone else is chasing the shiny object. That $1,000 is your starting point, not your finish line. In a year, it might be $1,200. In 5 years, maybe $2,000. In 30 years, if you just leave it alone and keep adding to it, it could genuinely be life-changing money. But only if you actually start. Only if you stop waiting for the perfect moment or the perfect strategy and you just take the first step. So, here's your move. Close this video, open a brokerage account, set aside your emergency fund, invest the rest exactly how I showed you, and then forget about it. Check back in a year. I promise you, future you is going to be grateful you finally stopped overthinking and actually did something. If this helped, hit subscribe, drop a comment telling me what you're investing in, and I'll see you in the next one.